From Kansas State University, this is Agriculture Today. Eric Atkinson here. Here's what's coming up. K-State's Dan O'Brien remarking on this past week's grain market trends as the bullish run in prices stalled out over the last few days. Dan will also go over his latest longer-term outlook on prices as shared in a K-State mini risk and profit conference session this week. Then K-State's Brian Briggeman will talk about the state of the U.S. macroeconomy moving into 2021 and the associated outlook on interest rate trends. Brian suggests that you producers may have an opportunity to capitalize on the expected economic conditions this year with potential for operational investment and growth. And later on Kansas agricultural weather, K-State's Mary Knapp. All this and more right here on Agriculture Today.
Kansas farmers and ranchers are helping feed your family in the world. The largest contributor to the Kansas economy is beef cattle. How do you get that juicy steak on your plate? In order for you to enjoy your tasty meal, it requires the hard work of the producers, marketers, advertisers, processors, inspectors, transporters, packers, and consumers. So thank all these people and sit back, relax, and enjoy your tasty meal.
Welcome once again to another Agriculture Today on the K-State Radio Network. The grain markets, our first order of business as usual on a Friday. Aboard once again is Dan O'Brien, grain market economist with K-State Research and Extension from his office in Colby, Northwest Kansas. So Dan, just a quick recap of what's happened this past week. The markets have been white hot, and they did cool off some.
Well, from their high perch that they'd gotten to, especially in soybeans and in corn, we've seen some come down from that, but we're still at tremendous price levels. Again, when you look at where the futures are at, corn, 520, 530 thereabouts for the March contract. Note that the new crop contract, 453. So we are seeing some anticipation of markets of supply-demand balances starting to grow again with a successful crop this summer. And again, prices instead of right now at, again, 528, 530, something like that for the March contract out there in Dees, they're ticking off, well, about 70, 80 cents down to about 450. So, we'll be watching the behavior of that new crop contract really from now literally all the way through the growing season. And for soybeans, as we look at where we're at, been touching up around 14 thereabouts. November fully $2 lower than that. I've had questions come in this past week, Eric. What's maintaining corn so high? People can understand the demand pull for soybeans, but how come corn's so high? Well, there are some problems with corn, but also there's this relationship that the markets seek to hold in terms of soybean to corn price relationships, especially as we come into planting season, and especially for those new crop contracts. So we've been bouncing around 2.6, 2.7 thereabouts for a good while. And if we saw soybeans run way up and corn just stay stagnant, then you really do leave the door open, particularly on those new crop contracts, to see literally sharp reductions in corn acres. And that for the sake of ethanol plants, livestock feeders, exporters, et cetera, is something they would hope not to happen. So I think we're seeing that. I would say also for wheat has been holding up decently as we look at this. They're somewhere around 630, 650, 640, and about in the middle of where we've seen here of late. That's the March contract. The new crop contract is, if anything, trending up a little bit to 641, 642. And the wheat supply-demand balances, well, I guess when you look at the U.S. export pace and stack it up relative to other years, we're doing very well. But when you compare the pace we have, even as good as it is, to what the amount of weekly shipments we need to meet the USDA's projection, we're running behind. So the cautious attitude I'm sort of developing on wheat is that what we're doing now is tremendous in terms of prices, and the pace isn't too bad for all U.S. wheat, but we run some risk. It's seemingly more and more as we go along here of getting to the end of this marketing year. And although we will have had a pretty decent wheat export year, still have to see the USDA when they get into the May and the June supply-demand balance sheets, the WASDE reports, to have to scale back the wheat export projections they had at 985 million bushels, take 50 to 100 off of that. And if they do that, almost all of that A little bit going to feeding because corn prices are high, but most of that is going to go back into the ending stock. So instead of this 836 million bushel number they have, you got 50, 100 onto that, you're at 936, and you start to scale back the optimism in the wheat market. That's something to watch. And I know wheat producers in Kansas are pretty hesitant to do a lot of aggressive forward pricing given the uncertainty of what's out in the fields, particularly in the West where it's dry. So even with all that risk and uncertainty, still you do wonder about doing some type of forward price protection, given that there's some risk out there as we head off into late May, early June, and July in the wheat market.
And as a matter of fact, and this is the core of what we'll discuss today, you shared some of these things to key on in each of the grain complexes in that mini risk and profit conference session earlier this week. And let's revert back to corn for a moment here and looking a little longer term. Of course, as you said, the planting intentions of producers heading into this spring will be one of those things. And what else is on the plate there?
Well, we'll figure out how we're going to finish up this marketing year first. And there's the likelihood of high prices having some impact on the usage industries. The USDA basically said as much when they made the adjustments that they made in that new crop 2020-21 supply and demand balance sheet. They scaled back feed usage, scaled back ethanol usage, scaled back exports, all 50 to 100 million bushels. If that happens more, to some degree, it won't be probably as much now, you would think, because they took the big chunk off the top. But instead of this 420 that they've projected for this year, you could see a softening in the marketing year average price, well, probably 20 cents, ending up with, say, a $4 average. If, though, these issues in South America continue and Chinese demand comes in on the feed grains, particularly and affects corn also along with grain sorghum, then you tighten things up to get below 10% stocks to use, ending stocks closer to 1.4 billion bushels. And you're looking at pretty strong prices through the rest of this marketing year. And the rest of the marketing year takes you basically to the end of August. And, you get up to 440. I just think that we're so focused right now on what's right in front of us, these export issues, problems in other countries, et cetera. We have not dealt one twitter on production risk and what it could do to the markets as we come into our own planning time. It's supposed to be a La Nina year, depending on what weather map you see, soil moisture map. You see just okay conditions, nothing startling. So I know where we're at now. We're assuming no weather issues. We're going to wait till they come before we deal with them in so many words. But the weather volatility that we could see this year would be something. And with these high prices, what will we do for the corn versus soybean acreage debate? In essence, I show for next year, that 21-22, well, basically for this year's corn crop, if you look at either the same planted acres or you jump up by about 2 or 3 million acres, basically about 2.5%, then it does have an impact on prices. If we could go up 2.5%, say get to 85 million acres planted, have yields about 173, the average of the last 5 years, 173 bushel an acre. You get 14.75 billion bushels, and you end up with ending stocks to use about 12%, stocks about 1.7, 1.8 billion bushels, and a price of about 387. That's just about where we've been, and a few cents higher than the last several years. So that's what I would see on the corn side. And really, it kind of begs, Eric, to see what we'd see on the soybean side, for the other side of that coin. Right. Well, if you end up and have a 3 to 5 million acre increase in soybeans, and that could very well happen in the eastern corn belt. We'd see some of that here too. You end up with supply-demand balance situations off for the 2021 year. You end up with about 4.3 billion bushels. And you have a recovery in ending stocks, as I've calculated them on the side here, up to about 250 to 300 million bushels. Again, a lot lower than we've been of late, but not as low as we are now. And you have a moderation in prices. You're at $9.50, $10 instead of what we're looking at now. Here, the USDA's latest projection, they've raised their price projection up to $11.15. Well, that'd be more like 9.5 to 10. So that's what's really at risk this year. The prices we have now are tremendous for these crops, and they'll bring a response. And if we increase acres, don't have a short crop, then you'd be looking at least a moderation in prices out into the fall of this year.
Just a quick note here. We've talked regularly about that battle between corn and soybeans for acreage, but we're not really talking much about the battle between corn and grain sorghum, which is a rarity, but that has to be contemplated here, doesn't it, especially when you think of our high plains conditions?
Is that more than just a Kansas story? That's my question. Right. In Kansas, it's going to rage. And we hear through this winter, and I'm going to meetings this week and coming weeks talking about grain sorghum as a crop and how to manage the price risk and production risk of it. It seems with all the enthusiasm and the high prices, tremendous basis, basically, demand-driven export pull from China, we'll see a fair increase in Kansas grain sorghum acres and in some of these surrounding states. You know, this grain sorghum issue, I remember 2 years ago when we had such problems getting corn in the Eastern Corn Belt. You know, they could have planted grain sorghum in those areas, but they didn't because they weren't set up to handle it in the elevators. It's a Kansas, perhaps southern Nebraska, Oklahoma, Texas issue largely. And I've done some figures. You add 15% planted acres across the United States to grain sorghum, and most of that coming here in Kansas and Oklahoma, as we said, Texas. You get closer to 450 million bushels of production. But if exports are strong, it may not make that much difference. The whole issue is that these price differentials that exist over in China, again, between corn and grain sorghum coming in, and extremely high priced corn over there, that demand pull that goes inexorably towards China right now. And again, China, 95% plus of all the business in sorghum is coming out of there. And so it's a very strong, very narrow demand base, as we've been saying, likely to continue, but any tremor of disagreement between these countries, I just am cautioned by that last go-around when we had trade negotiations where some of these crops were vulnerable to that. So if we have these situations, gosh, it'd be good to try to protect yourself and maintain some of these basis levels going into the future. I know that involves forward contracting, but we sure want to do it to protect ourselves from things going away.
We'll call that good for this week. Dan, thanks as always for the input.
Thank you, Eric.
Dan O'Brien, grain market economist, K-State Research and Extension, here on Agriculture Today.
Did you eat today? Thank a farmer. A way to get more involved in agriculture is through 4-H and FFA. Through 4-H and FFA, we have been given multiple opportunities to grow as leaders and learn more about agriculture.
You can learn skills related to jobs, public speaking skills, and you get the opportunity to travel around the country and meet new people.
If you want more information about getting more involved in 4-H and FFA, visit them on their websites at kansasffa.org and kansas4h.org.
Next up for you on Agriculture Today, yet another presentation as part of the mini Risk and Profit Conference series that K-State Agricultural Economics is putting on. And this time, the macroeconomy and the interest rate outlook for 2021 was the theme. Joining us now is the director of the Arthur Capper Cooperative Center here at K-State and an agricultural economist, of course, Brian Briggeman. He's the one who shared this information. Brian, having seen your presentation, it was interesting to note that as we head into this new year, your view is something on the optimistic line for this economy looking forward.
Yeah, I agree, Eric. I think coming off of 2020 and the pandemic, there was just so much uncertainty, so many shutdowns, pullback. But as we are turning into a new year and looking ahead for 2021, I am optimistic that we can begin to build up consumer confidence. Because when you shut down an economy that is driven off of consumption and you erode consumer confidence because of lockdown measures and, limits on capacity and limit on travel, that's what we need to get back. So, looking at, as we're distributing the COVID-19 vaccine, we'll begin to start to pick up some of those, maybe that consumer confidence, and we'll begin to start spending, hopefully maybe travel a little bit more. So a lot of that, really kind of hinges on us coming out of the pandemic. And I am optimistic that we'll be able to do that this year.
Some of the principal things that you highlighted as you talked about the overall economy, the labor market And, of course, interest rates. What were your views on those?
So with the labor market, when we did shut down, we had a huge surge in unemployment insurance claims. It continued claims was well over 25 million, and we'd never seen that before. But as we begin to get back to the workforce and begin hiring again, our unemployment rate has actually dropped down now to 6.7%. We're not where we were before the pandemic, which was considerably low, around 4%. But the labor market has improved. But the one aspect of the labor market where you still see a lot of those unemployment insurance claims continue to be is on the service sector side, which makes sense because we haven't seen a lot of, the consumer confidence and people going out, traveling, vacationing, doing those types of service sector jobs. So if we do get that back, we could see a big improvement within the labor market. We very well might add the most jobs we've ever added in the United States over the course of this year if we can get that confidence back.
Mm-hmm. The other one, though, that has producers' interests, pardon the expression directly, would be interest rates. Right. The hope is that the ongoing trend of low rates would persist throughout this calendar year. Is that the likelihood?
So looking at 2021, as I look at the data, read reports, follow others that, really follow this closely, and in my own opinion, is that for 2021, short-term rates are going to remain low. I mean, the Fed, in fact, has come out and said that short-term rates will remain low at the zero bound for at least 3 years, if not more. So I think for 2021, the short-term rates, they're going to remain low. But for many in agriculture, I've spoken with many farmers, ranchers, agribusinesses, cooperatives, even lenders. There's been a tremendous opportunity to lock in lower fixed rates. So for your listeners, if you have been thinking about going out and looking and exploring, locking in some lower rate financing, now still there. There are still opportunities to do that. But if the economy begins to recover, like many are expecting throughout this year, that will have an effect of pushing up those longer term rates. We'll begin to see that begin to creep up. And in fact, that would be a good thing that we would need to see as the economy begins to recover. But for now, there are definitely opportunities on that long-term lower fixed rates.
Well, we're talking about agricultural financing here. The other alternative would be the variable rate type of financing. Right. So is that, given the extended outlook for low interest rates, out the window for the time being?
Sure. So if we look at variable rate financing, it's very attractive. But of course, it is just that variable rate, right? So, and you got to weigh it versus that fixed rate. And currently, the spread between the two isn't quite large enough in order to say, all right, I'm going to take on the variable rate financing, it's worth it. Because if you can lock in cheap, a low interest rate for an extended amount of time, that makes a lot of sense. But there are indications right now as you begin to look at the yield curve. So looking at the relationship of longer-term rates to shorter-term rates, where that spread, where you're seeing longer-term rates, is beginning to increase. And there was a period of time very recently, from about 2011 to about 2015, where the spread between the short-term rates and long-term rates was quite large. And it made a lot of sense to utilize a variable rate product. And it's not quite there yet, but indications, again, the economy recovering, we're beginning to look at that spread between longer-term rates, shorter-term rates is beginning to widen. I would keep an eye on it about mid of this year, looking later at the end of 2021, that it might become more favorable.
Other things to ponder here, one of which you brought up in your presentation, the level of public debt. Of course, a hot button topic, and given for one thing, the enormous aid that was given for the coronavirus and the pandemic relief, our national debt, federal debt, has ballooned considerably. Right. What about that angle, and how important is it on the farm or ranch?
Well, I think where it becomes important for the farm and ranch is many of your listeners either went through the 70s and 80s or are of an age where they've heard plenty of stories shared about how difficult of an inflationary period that was. And we know how the Fed will fight inflation. They will let interest rates rise. So that's the fear. Are we going to have that run up in inflation? Because everything is set. When you look at the public debt, we're over the total public debt for the government is over 100% of their GDP. The last time we were at that level was back in World War II. And then if you look at the Congressional Budget Office's projection going out to 2050, when you consider things like Social Security and Medicare, Medicaid, all these other programs, we're approach 200% total federal debt to GDP by 2040. So there are some concerns out there about, well, could we have a lot of inflation? And furthermore, why are we continuing to have discussions about adding even more debt, doing another coronavirus COVID relief package? Well, the one thing that's important to remember is that we do have exceptionally low rates currently. So if you look at, the federal government, when they issue this debt, they do have to pay interest on it, right? If you look at the federal interest that was paid, or being currently paid at this 100% mark that we're at, it sets below 2%. It's like 1.8%, very low, very similar to like what we had back in World War II. And if you look back in a time when we actually had very high federal interest, up near 3.5%, was back in the mid to late 1990s. And we didn't have near the debt levels that we had, primarily because it was expensive. And also at that time, we did have a balanced budget for the government as well. So the reason that at least the prevailing thought of having this debt is manageable at the moment is because of very low interest rates. But I've yet to meet an economist who would say 200% is manageable on a debt to GDP ratio, because it's not. There has to be an exit plan, right? And so as far as, inflation right now with low rates, you look at market expectations, you look at what the Fed is saying, you look at just low real wage growth, we're a global economy. There's just so many reasons why we're just not seeing that inflation. But the risk is there. It could happen. So the question will be going forward, are we able to unwind and begin to reduce that amount of debt to a more manageable level when interest rates rise?
But the take home here is that for the here and now, that is 2021, the agricultural producer is sitting pretty well in as far as the general economy, how it's going to impact their well-being.
Certainly. I feel, agriculture, farmers, ranchers, agribusinesses, co-ops, are in a very good position. You look at what's going on in commodity markets right now, there are plenty of opportunities in order to lock in profitability for the future. Build up that balance sheet. Have that liquidity to the best you can, because there are going to be opportunities, for growth, for expansion. But if you're not in a position in order to take advantage of that, have that ability to take on either more debt or either take on an additional asset for growth, then it's very problematic. It could be challenging. But as far as like where the economy is laid out and going forward, it does look to be pretty bright.
Good insight. Brian, as always, thanks for stepping over and sharing all of that with us right here.
Thanks, Eric.
Over from the Arthur Capper Cooperative Center in the Department of Agricultural Economics at K-State, that's the center's director, Brian Briggeman. Again, he shared his thoughts on the macroeconomy at a recent mini risk and profit conference session put on by K-State earlier this week. We'll return after the break. You're listening to Agriculture Today.
With the shortage of primary care physicians, especially in rural areas, health education and disease prevention are vital. K-State research and extension programs address quality of life, personal development, and health behaviors across all life stages of all social economic groups. To learn more about health education, one of K-State Research and Extension's 5 grand challenges, visit www.ksre.ksu.edu.
Coming to you from the campus of Kansas State University, this is Agriculture Today. Welcome back. Eric Atkinson with you. Now today's agricultural news headlines, courtesy in part of DTN. A federal court will review the EPA's latest decision to grant those 3 small refinery exemptions to the renewable fuel standard, pending a full review of the action. The U.S. Court of Appeals for the District of Columbia Circuit issued that order yesterday morning, following the EPA's decision back on Tuesday to grant 2 of 32 exemption requests for 2019 and 1 for 2018 that was previously denied. The Renewable Fuels Association initiated the court action, saying that the 2 2019 exemptions would amount to another 150 million gallons of lost renewable fuel demand, and the 2018 exemption expected to result in a loss of 110 million gallons of biofuel demand and was previously denied by the agency. Now, a federal appeals court ruled last year that the agency had illegally granted exemptions to 3 refiners back in 2016. An appeal by refiners in that case will be heard by the U.S. Supreme Court. As former USDA Secretary Tom Vilsack awaits Senate confirmation for his return to that post in the Biden administration, what do some other former Secretaries of Agriculture see as important farm and food policy issues in the new presidential administration that it must address? Here's more from the USDA's Rod Bain on that.
A new presidential administration means what for farm policy? Former Secretaries of Agriculture weighed in with some thoughts on that subject recently.
I think there's going to be a renewed focus in trade, rural development, nutrition, and what I call equity in agriculture, including more diverse farmers.
Adequate spending for the research agenda to protect farmers, ranchers, consumers, and our food supply generally. And a lot of the research has to go into zoonotics.
I think that USDA can play a very important role going forward in how to facilitate the discussion about supply chain and how to avoid long disruption of markets in the future.
Former Secretaries Mike Espy, Dan Glickman, and Ann Veneman, respectively. Meanwhile, another former secretary awaits confirmation from the Senate to reassume the post he held for 8 years, as Tom Vilsack is the nominee of President Joe Biden to serve as Agriculture Secretary in his administration. I'm Rod Bain reporting for the U.S. Department of Agriculture in Washington, D.C.
Nearly 3/4 of all established dairy operations in the country have now enrolled in the USDA's Dairy Margin Coverage Program for the 2021 program year. With a closer look at that, the USDA's Stephanie Ho.
The number of producers who signed up for dairy margin coverage for the 2021 program year has increased by nearly 5,000 enrollees, from about 13,500 in 2020 to 18,500.
Last year, we had 51% of dairy producers signed up for dairy margin coverage.
Marin Bozich is an assistant professor at University of Minnesota.
Had this program been in existence over the last 10 years, for 15 cents premium contributed to the program, average payout per hundredweight would have been $1.38.
In other words,
for every $1 paid in premium over the last 10 years, producers would have collected $9 in gross indemnities, in gross payments before premiums.
Through the Dairy Margin Coverage Program, USDA's Farm Service Agency offers protection to producers when the difference between milk and feed prices fall below a certain dollar amount. This is Stephanie Ho for the U.S. Department of Agriculture in Washington, D.C.
And you're listening to Agriculture Today. There are numerous subplots to the story of Kansas wheat production, and they've all been captured in a new video presentation produced by Kansas Wheat. The hope is that this project will give multiple audiences a greater insight into the Kansas wheat industry, as outlined here by Marcia Boswell on this week's Kansas Wheat Scoop. Marcia?
Kansas wheat leaders Justin Knopf and Kyler Miller-Shasky and K-State wheat breeder Alan Fritz shared their stories in the new film, Wholesome, The Journey of U.S. Wheat. U.S. Wheat Associates produced the 25-minute film to demonstrate how the passion, purpose, and investments by the people in the wheat industry are integral to the commodity's reputation as the world's most reliable wheat. According to U.S. Wheat Associates Vice President of Communications Steve Mercer, in our organization's mission to promote U.S. wheat exports, our representatives focus on the consistently high quality of our supplies. Through this film, the people at every step of the journey to export tell their own stories about how they thoughtfully produce new varieties, care for the land and the crop, and handle the wheat responsibly to ensure it meets customer needs. This is an educational program that makes the stunning beauty of the land and the emotional attachment of these dependable people to the industry a key part of the story. Alan Fritz discussed how wheat breeding programs, like that at Kansas State University, work to develop and release wheat varieties that help farmers address production constraints and meet specific wheat food needs to bring healthy, nutritious food to the table. He said what we are doing is taking the opportunity with the natural genes that we already have to put those together in a package that is the healthiest and the best for the environment that we possibly can. Justin Knopf, a fifth-generation farmer in central Kansas and president of the Kansas Association of Wheat Growers, discussed how wheat farmers monitor the crop throughout the growing season, emphasizing how farmers take great care in choosing what products to apply to their fields. He said, when I make the decision to use a particular product, whether it be to fertilize the crop, to give it the fertility that it needs to grow and produce nutritious grain and good grain quality, or to use a fungicide to protect the tissue from a fungal disease that's affecting it, I always weigh those trade-offs with the end in mind. Consumers can be confident we've done our due diligence at making those responsible decisions and weighing the trade-offs when utilizing products on our farm. Kyler Miller-Shasky, a third-generation farmer from southwest Kansas, also emphasized how Kansas farmers are proud to produce an abundant supply of high-quality wheat generation after generation. He said, I would say as a farmer, as a wheat grower specifically, there's certainly a responsibility and a weight that you feel not only to provide a high-quality product, but enough of it to feed the world. We want to have the bragging rights that, hey, we've got the best wheat in the world. Buy from us. You can get a link to Wholesome, the Journey of U.S. Wheat on our website at kswheat.com. For Kansas Wheat, I'm Marcia Boswell.
All right, Marcia, many thanks. And to remind, once more ahead of the break, our podcast service is as handy as going to agtoday.net. You can subscribe to an automatic download of each day's broadcast right there at agtoday.net. Mary Knapp is in next. You're listening to Agriculture Today.
When you are in need of timely, reliable, and trusted information, K-State Research and Extension is here. Whether it's organizing people, information, or resources, they have the necessary tools. Community comes first for K-State Research and Extension. For more information and to connect with your county's extension agents, visit www.ksre.k-state.edu.
Now on Agriculture Today, our weekly glance at Kansas agricultural weather. And alongside once more from the Weather Data Library here at K-State, Research and Extension climatologist Mary Knapp. And Mary, it's obvious to everyone now that La Nina has an ever firmer grip on our weather conditions here in Kansas. We're well entrenched in drought in so many places.
Right. We didn't make much in the way of changes in the U.S. Drought Monitor this week. They did trim a little bit of the edge of the drought to drought-free along the southern areas where they are the ones that at the 30, 60, 90-day are a little bit ahead of the game. But as we saw last week, the northwest and north central, we had some deterioration in that, and that did not improve. So we've got a good portion of the state that is in moderate to severe drought, and looking at the drought outlook doesn't show any encouragement for improvement in that. When we look at last week's moisture, only 2 divisions actually averaged measurable moisture, and those were the northeast and east central, as that system that we saw last week was exiting the state. But while they averaged measurable, we're talking 300ths and 400ths of an inch per division, which is 15% of what they would normally see during the week. So the fact that they actually had some didn't go very far.
We're in a weather rut here in Kansas because we see these systems go to our north, go to our south, and here we are stuck in the middle with very little, if anything.
Right, and that pattern doesn't look like it's going to shift a whole lot. There's another system that's expected this weekend, starting Saturday night, going into Sunday and Monday. There's going to be colder air along with that, but the amount of moisture in western Kansas is less than 1/10 of an inch. And as you get along the eastern areas of the state, along the Missouri border, we may see as much as 1/2 an inch. You go over the line into Missouri and into Arkansas, and they're talking 2, maybe 3 inches of moisture. So again, it's moving around the Rockies and coalescing to our east. Oklahoma has fared better than we have. North Texas has fared better and has seen some improvement in their drought. There's also been a little bit more to our north in Nebraska. But if you go further north into the Dakotas, they are suffering from a snow drought as well. They are more likely to have consistent snow cover in the Dakotas, and they have not seen that this year. Winter recreational activities such as ice fishing have been particularly perilous because, again, the winter has been more open and haven't had that persistent cold.
We haven't either of late. You look back at this past week, warmer than normal temperatures, more or less as advertised.
Exactly. One thing that has been in our favor, though, is that while we have had these nice mild highs, we have been fairly consistently dropping below freezing for our low temperatures, and that will slow the emergence of the winter wheat from its dormancy. You start getting to these nights where the nighttime temperatures stay in the mid-30s, and we're going to see things start breaking dormancy very quickly. One thing that they talk about is chill hours, and that's the amount of cold temperatures that help set the plant to begin to break dormancy. We've already accumulated all the necessary chill hours for that, and they have to our north as well. Usually it's too cold for those to develop because you have to have those temperatures between about 45 and freezing, and so if it's outside of that range, it doesn't count. Well, we've had it. We're going to be very, very leery of that early dormancy break because winter's not over yet. We still have plenty of time to have some really cold air, and we just don't want our crops to start thinking it's spring too early.
Well, then, that system moves in the latter part of this weekend into early next week. Looking beyond next week and then the 6 to 10, 8 to 14-day forecasts, more of what we've seen, sort of status quo?
Well, the 6 to 10 favors wetter than normal, so we might squeeze some fairly significant moisture out of this system and another one that's following on its heels. But as we go out a little bit further to the 8 to 14 day, we're back to dry. We look at the February outlook, it's neutral, equally likely to be wetter or drier than normal. February is still one of our drier months, so it doesn't take much to move us above normal on that. But if we look at the extended outlook, the February, March, April, that favors drier than normal, and that becomes much more critical as we move into that March-April timeframe. We're ramping up on what amount of moisture we would expect to see, and we will dig our hole into drought much more rapidly if we start missing out on rains in March and April. On the temperature side, it's favoring warmer than normal across the period, both this coming week, the 6 to 10, the 8 to 14, the February, and the February through April period. That doesn't mean we're not going to see cold air, but the cold air will be fairly brief and not persist for extended periods of time.
All of this begs the question, is there an end in sight to the La Nina? And that's been a topic of discussion, you say.
That has been a topic of discussion. Right now, the models favor that the Pacific Ocean waters will go back to a neutral phase towards the end of the spring in the April-May timeframe. But what they're really watching is how long it will stay neutral. There is some indication that it could revert to a La Nina as we move into the fall. And as we well know, that's not a positive pattern for us in Kansas. So we'll have to see how that develops.
All right, then. Thanks as always. Enjoy your weekend, Mary.
Thanks, Eric. You as well.
She joins us every Friday to get into the Kansas agricultural weather scene. Climatologist Mary Knapp, K-State Research and Extension, and likewise, the best to you this weekend. Thanks for tuning in. Eric Atkinson here. This has been Agriculture Today over the K-State Radio Network.